So I'm I'm Philip Brittan. I'm the CEO of Crux Informatics, and we are a new company just launched earlier this year. And essentially, we help our clients who are financial institutions find and make use of relevant data. Just as a little bit of background, the way we do that is we work with a network of suppliers, folks who've, vendors and others who've got very interesting sets of content that are relevant to financial institutions of various kinds, and I'll go into a little bit of depth about what they do with it. And then we have a platform and a managed service to help them deal with all the grungy data engineering aspects of working with data. Cleaning the data, as you just heard, for those of you who are in this room, heard the previous folks talk about how to clean data, a number of use cases, mapping the identifiers so that multiple data sets are joinable, normalizing the data in various ways, potentially joining data together, deduping entries in data, basically all the sort of data wrangling or data preparation work that's needed to take a data set from its raw form into something that's actionable, that clients can do something with. Now, in our case, we're dealing with financial institutions, so generally the use cases are wanting to look at data to do some underlying research to figure out, does a particular investment thesis work, or to write an algorithm against that data to try to generate returns in the market based on some signal that data is giving us about which securities, which stocks to buy and sell at what time. Or it might be to generate a risk signal to tell us when things are getting extra risky in the market. Maybe we should exit a particular strategy or exit the market altogether and go into cash, for instance. Or for some firms like insurance companies, kind of financial institution, maybe to help us figure out whether a policy makes sense to underwrite or not. Now, in financial services, there is, sort of the core process of any financial institution is to take in information about the world, do analysis on that information, and try to arrive at some ideally unique and valuable insight, and use that insight to drive an action of some kind. That action might be to place a particular trade, or to construct a portfolio in a certain way, or to make a decision to buy a company, or pitch a client on an M&A deal or something like that. So lots of different actions, but fundamentally, all financial institutions are in the business of taking in information about the world, doing analysis on that information, on that data, and arriving at some kind of insight. And so in order to feed that core process, firms are constantly on the hunt for new and different and additional sources of data that might give them some new perspective on the world and potentially give them an edge in generating bigger returns or mitigating their risk or making better client decisions, better underwriting decisions, et cetera. So what I'm going to talk about today is just to give all of you a little bit of a flavor of that process of finding and evaluating in the short period of time that we have available here, just a flavor of evaluating a new data source for potentially something I want to leverage in my investment strategy. So we're going to pretend that I'm, say, a hedge fund who's trading in the markets, and I'm looking for sources of data that might be interesting to me, and I want to try to figure out if this is going to be additive or not. I'm using the Crux platform here as kind of as a backdrop to the things I'm doing. And right here, what we have is a set of a whole bunch of different sources of data, some pricing data, some fundamental data, a whole lot of different alternative data. And I can go through here and sort of look at different kinds of data that maybe resonate with me based on the sectors that I'm investing in, the sort of thesis I have about the world, and decide if something looks interesting or not. I'm going to, for today's purposes, I'm going to home in on this Minkaboo data from one of our partners called Pluribus Labs. And Pluribus pulls in a lot of interesting kinds of alternative data, Minkaboo data, is essentially crowdsourced stock purchase recommendations from Japanese retail investors. So they gather, buy, sell recommendations from thousands or hundreds of thousands of Japanese retail investors like you and me on what stocks they think should be bought and which ones should be sold. And they aggregate all of that and turn it into a crowdsourced sort of signal that can be used. So again, I'm going to pretend I'm a hedge fund, and I think, oh, that's interesting. I'm investing in the Japanese market. I like social signals. I believe in the wisdom of the crowd. I'm going to see if this is valuable to me. So there are a few things I'm going to want to do in order to determine whether any particular set of data is going to be valuable to me in my investment process. So first off, I'm going to indicate that I'm interested. Minkaboo Pluribus gets gives me an evaluation access to the data, and I now have my Crux drive here with a whole bunch of artifacts in it, some data, some queries, some white papers, which I'll show you, which the vendor in this case is putting out there to help me as a potential customer make use of their content. Now, as I'm looking at a potential source of data, there are a few different dimensions that I need to think about whether this is going to be useful and kind of what the ROI on this data might be. The first is data integrity, and again, this is something that the previous speakers in this room spent a bunch of time on. How dirty is this data? Does it have gaps in it? Does it cover all the stocks? They say they cover Minkaboo here covers 4,000 Japanese equities. Does it cover exactly those names, no more, no less? Over what time period? Are there gaps? Is there a missing week somewhere in the historical data? Is the data very messy? Are there outliers? Are there strange, unrecognized values? There's a whole bunch of tests on pure sort of data integrity that I would probably want to run first, just to see what is this data like to work with. And it's not going to make much sense to do an evaluation of the investment potential of the data if it's super, super dirty. Obviously, I'm feeding dirty data into my model. It's going to break, and I don't know whether it's the dirty data or whether the data just doesn't have any investment return potential. So first I'm going to look at that integrity, probably take some of the key factors, fit distributions to the observed data, then look at what the outliers are. Say any data points that have a less than 1% probability of having existed compared to the fitted distribution. Probably good points to take a look at and say, does that make sense? Is there an intuitive reason that data should be an outlier, or does it look wrong? Does it need to be removed or interpolated, imputed in some ways? Certain kinds of data, you're going to want to do that on a sort of a derived set. So for instance, time series data, when you're looking and say a price is moving, it's not so much the number itself as the movement. Those sets of data tend to move within fairly rational amounts from day to day or moment to moment. And so there you're probably going to want to fit a distribution to the actual movements and then look for outliers. Did you get a big spike, a huge jump, a huge drop that's extremely unusual? Look at the news. Was there a reason for that? Was there an economic number that, unemployment numbers came out and they were way off expectation? Everyone sold or bought. Was there, crisis? Did North Korea just launch a ballistic missile, for instance, which just happened? So did the market react? So is there an explanation for it? So there's a whole lot of stuff on sort of the data integrity side. The second dimension is looking at whether a particular source of data is additive or not. If you've got a portfolio of data sources you're already using in your investment strategy, a new source of data may look and sound different, but in fact, it may be highly correlated with data you already have. And so you're going to want to check, is this really different? Or is this just the same? Is this telling me the exact same thing, just using different words? And so there's a variety of ways to do that. The best way, of course, the most solid way is actually to use the data in your investment strategy and see, did that improve your returns or not, or does it stay exactly the same? That's very laborious way to do it. You have to go pretty far down the road with that particular set of data in order to determine whether it's adding anything to your strategy or potentially taking away from it, or is it sort of irrelevant. There are quicker ways, like simply looking at the correlation with other data you suspect might be the same. Just, are they correlated? Are they not correlated? If they're highly correlated, then it's not going to be telling you anything new. It may be that a new data set is highly correlated with something you already have, but it leads it a little bit. So it's not telling you something different, but it's telling it to you sooner, which is obviously more valuable. The sooner you get a sense of where the market is going, the more chance you have on capitalizing on movements and improving your returns and mitigating your risk in the market. Then the last dimension, which is the one I'm going to drill a little bit deeper on today, is the alpha content, which is, what is the investment returns that I can generate by using this data to give me some kind of signal, a signal that tells me what to buy it, what to sell, when to sell it, and is there a return? Am I going to make money by using this data to inform my investment decisions? That's alpha, and it is a complicated matter, because most data you don't just simply plug in and it tells you buy, sell. It's usually giving you some underlying factor, and then you have to build some kind of algorithm or model to use that data to turn it into something that you can act on. Now, what we have here, as I said, is a bunch of data that's been aggregated across thousands of retail investors in Japan, and their sense of saying whether they, as individuals, want to buy, think you should buy, think you should sell. Is this a good stock to own right now or not? Over a long period of time, over 4,000 different equities. And this is just to give you a sense of the underlying data there. We need to turn that into something that we can use. We got thousands of people telling us what to do. So what do we do? Well, fortunately, Minkaboo, in this particular case, includes a white paper. Not all data vendors do this, but they include a white paper that is a suggestion of a model. How can I use this data to generate a buy signal, sell signal for myself, and generate returns? So they're trying to help their customers get value out of that data. And I read the paper, and basically it says, we're going to aggregate those buy and sell signals, but we have to be careful, because sometimes people will say buy a stock, and then they'll kind of wander away from the platform and they won't adjust it. So, you may, if you just look at any given point in time at how many buys there are versus how many sells, it may not be high conviction, because some of those might be kind of stale. So basically they're suggesting you look at just when somebody switched, right? When they switched from a buy to a sell or to a sell to a buy, they made an explicit action. They purposefully went in and changed that. So they have a high conviction around that. So we're going to build a model based on what they're suggesting here. And we're going to do it in a couple of different ways. So we're going to build part of the model in a query. So I've created a query here called run signal. And basically we're going to test this against a particular Japanese index, the Nikkei 225. It's 225 of the biggest stocks in Japan. And basically behind the scenes here created a big query, SQL query, that for each of these different companies, for this different period, and we're doing it on a monthly basis, it's giving me a signal of a 1 or 0, meaning the model is saying I should own the stock, during that month, or I should not own the stock. So if it's a 1, if I don't own it yet, I should buy it. If I already own it, do nothing. If it's a 0, if I own it, sell it. If I don't own it, do nothing, is basically what this is doing. Then I'm going to use that query to feed into, of course, a Python-based model where I can test this out and backtest it. And one of the things we have in the Crux platform is we've just baked Jupyter Notebook right into the user experience here so that you can quickly write up or create models in Python in Notebook, and the back end of this Notebook is running on the same infrastructure where we're storing the data, which happens to be the Google Cloud, and so you don't have to send the data over the wire. So there's a good performance benefit to doing that, and it just makes it very easy to go in and pull data from multiple sources, create models, experiment, play around, which is often in the case of doing financial research or trying to create an investment model. There's a lot of experimentation, there's a lot of playing around, and in fact, today, I'm taking the white paper here that has a suggested algorithm for how to generate returns off this data, and I'll start with that, but then I might use that and start tweaking different factors and seeing, can I improve that? Can I get better returns or limit my risk better, improve the performance of that model by tweaking different things? But I'm going to use the suggested model as a starting point. I'm going to do something called backtesting, which some of you folks in the room are undoubtedly going to be very familiar with, and some not. And this is basically what I'm going to do. I'm going to run a simulation to tell me how well my particular model would have done in the past. And love to use open source frameworks, of course. There's one called BT here, which is a open source framework for backtesting in Python, and just pulling that in, and it's quite cool and quite simple to use to set up particular algorithms and then run it over a set of data. So here's my notebook, and basically, obviously, I've pulled in pandas. Of course, always need pandas, and then here's my backtesting and a financial functions library called FFN that I'm pulling in. Also pulling in our Crux API. This is an API we include that just makes it really easy to access Crux-based data repositories from within Python. And basically, what I'm going to do is I'm going to pull in price data that we've gotten from the Tokyo Stock Exchange on the Nikkei 225 stocks, and what have been their prices over say the last 7 years or so, I think is our testing period. And I'm going to show a backtest on that, and then I'm going to use the model that we got with the Minkaboo data to see what that does, if that adds to just a simple portfolio. So basically, here, creating a data frame with the underlying stock data, pulling it in, very simple. Doing the backtest right here, the basic monthly rebalancing across all the stocks in the basket, which is these 225 Japanese equities, equally weighted, nothing fancy. There are all kinds of weightings you can put on things, and we'll rebalance it on a monthly basis as stock prices move so that it's equally balanced again. This is the backtest right here. This runs the simulation based on these parameters. And here is a plot of the output. So if I simply held an equally weighted basket of the Nikkei 225 and adjusted the weights monthly to keep them equally weighted as prices change, this is how it would have done over that period. And BT now gives us, the ability to look at the plot and gives us a whole bunch of really cool statistics about that stuff that's extremely important to anyone involved in quantitative investment management. What is the return? What's the Sharpe ratio? What's the max drawdown? What kind of reversals am I, and white knuckle periods am I likely to experience while doing this this particular strategy? Then what we're going to do is compare this with the algorithm that we got out of that Minkaboo data set. And the way the backtester works is you send in all these parameters and you create a kind of a kernel. If you guys are familiar, I'm sure many of you in machine learning are familiar with the idea of a kernel strategy, which we've created right here, which is using that query that I ran a little while ago that gives the signals, and then aggregating those up, and then that's going to form the sort of strategy, the kernel of the backtester. We feed that in to the backtester here, and we run the strategy again. And here we've got, and then we compare the two. And here we've got the underlying data set, and here we've got the Minkaboo enhanced strategy. And we see that in some sections they're pretty much exactly in lockstep, and in some areas there's an improvement. The yellow line is the Minkaboo enhanced strategy, so we're getting improved returns in certain sections. And again, here I can get all sort of the summary statistics around that. So I can go through and see how this is performing. And what this now gives me is a basis to go in and look at this data and over what was happening in these particular time periods where there was separation. Is there something particular about what was going on at that time that maybe is giving me some kind of lift? Are there improvements to the strategy? If I changed the weighting, if I changed the way that I aggregate all those thousands of buy and sell recommendations coming from all those different retail investors, aggregate those together to create an underlying signal, is that going to give me a better strategy and give me more return, less risk, etc. And then I'm going to have to weight basically all these things together. See if I'm considering whether I want to license and use this particular data set, determine is this giving me additional alpha over my current strategy? Is it correlated with things I already have? Is it telling me something new, or is it telling it to me sooner? Is it going to be very difficult to work with? Am I going to have to be cleaning it a lot, normalizing it, etc.? And then make an overall decision. Is this something I want to license and put into production or not? Most data, as we were saying earlier, and as many of you or maybe all of you are intimately familiar with, is dirty and does need a lot of wrangling in order to get it to a point where you can build a model like this and actually test it with some confidence that the model is telling you accurate things about the data and is not simply telling you random things because the data itself is full of noise or has holes or has spikes in it or has missing values, etc. And so that's where the Crux platform and the Crux managed service to help clients sort of deal with some of those things come in. And this is what we do day in and day out for all of our clients. So maybe I'll stop there and see if anyone has any questions. Yeah. So it's both. It's both. We'll clean the data on behalf of the client so that they have clean data. Obviously, the data vendors, we want to help them. You want to push the fix as far upstream as possible. So we tell the vendors about any issues that we find. So ideally, they can fix it at the source. But in the meantime, and it may take a while for them to fix it, we'll clean the data sort of immediately so that it's actionable for the client. And also, the cleaning of data can sort of somewhat unintuitively can depend on the use case. So you may want to, there are certain use cases where you don't want to clean the data at all, where you want to, your model is really dependent on what the world thinks about a certain piece of data, not whether the data is right or not. And so if you correct it, your model is not going to be in line with what everyone else in the world thinks, because they're all seeing that same bad piece of data, for instance. So there are certain cases where you don't want to clean data. There are certain cases where you want to clean the data in a certain way. You may want to impute values in a certain way based on the eventual use case, in which case the underlying data vendor, the original vendor of the data, provider of the data, can do things, but you may still need to make some adjustments to the data in order to fit the use case. Yes?
How do you reflect that to the clients
who want both what?
Views, the corrected, the uncorrected.
Oh.
When was it corrected?
Sure, absolutely. So what we can do is basically we'll take in the raw data from the vendor, and then we can split it and create effectively two copies of the data, and we can have a cleaned copy and we have the raw copy. So some models, which I think is what you're getting at, some models will actually want to compare the raw messy data to the cleaned up data and look at some of those things. There's some where you've got mispricings in the market or different things like that. So basically the way we operate and the way the platform works, we can create multiple copies of the data. We can also store all the data as point in time so that you can look back and recreate exactly the data point for this day, like the price of a stock on July 8th, let's say. As of July 10th, the price was this, but as of July 15th, that price on July 8th has changed because it got corrected. And so you can reconstruct a whole history around a particular data point using point-in-time data storage and representation, which is frequently done in financial services. That's pretty standard way of doing it. Am I getting at your question?
Are you doing it, for all the data sources in the same way? So if I'm used to doing I have an API and I want to compare it to another data set, and I want to join them, it's very important that both be causal the same way.
Right.
So am I using the same? How do I know what's behind it, and am I using the same API?
So I'm sorry I wasn't repeating the questions. I'm not following instructions here. But so the question is, are we representing point in time the same way? Generally speaking, yes. But there are differences, again, based on the nature of the data and based on the specific use case of the client. Now, if the client has a need to join different things together, then obviously part of the data engineering work that we do is to make sure that we line things up the right way so that they can be joined accurately and efficiently.
There was one more question.
So how do you or your clients think about what amount of data you're going to expose for free in this evaluation back testing scenario? What you're only going to show a paid.
Right. So question is how much data does one show in an evaluation scenario? That's really because Crux doesn't sell or resell data. We're merely a platform for our partners, data provider partners, to make themselves visible to clients, and our main service is helping our clients make use of that data. So evaluation periods really depend on the vendor of the data and what their policies are. It's often a negotiation between the potential buyer of the data and the provider. One issue that we've tried to help, Crux just being a sort of neutral broker, is that evaluation data is often a subset of the whole data set. I say, well, we'll give you a little bit and you check it out. The problem, of course, as you can imagine, is that customers will say, wait a minute, you're picking and choosing the data. That data really does extremely well, but if I look at the whole time series or across all the stocks or whatever it may be, it doesn't look so good. So one of the things that we do to help is give data vendors a safe place to make all of their data available in a locked down environment on Crux, so that the hedge fund or the bank or the customer can go in and backtest across everything, but they can't take the data and at the end of a month or 2 weeks or whatever it is, like their access is cut off. and they never get a copy to take into their own environment.
One more question.
Oh, yes.
Two questions now that you, in what you mentioned is, how quick do you have to make decisions? So, I'm assuming that this data is used to make decisions, and the sooner the better.
Yes.
So if you're going to have these evaluation periods, you're looking at the future possible decisions rather than decisions today. How quick can you analyze and get the data ready for the buyer?
Well,
And so that they can make a decision. And the second question is, you started with these subjective data. The crowdsourcing is normally a subjective
Yeah.
in some way. But also you have, I'm assuming, also non-subjective data, real data. Where you have
Sure. Oh,
reports. How do
absolutely.
you use any way to correlate those two, these two, so that help the decision making?
Sure.
I don't know if the term correlation is correct, but what I want to say.
I think you mean corroboration is the word I would use to basically.
To link them, but let's say, to link in some way that it helps to make.
Yes. So a common pattern. If I'm understanding your question correctly, you want to know, is it, does it make sense to use different data sources and compare them in some way to help you make a better decision? And absolutely.
Yeah.
If you may want to take two data sources that are uncorrelated, so they're not just telling you the same thing, but that basically can reinforce. They come from completely different places. It may be a subjective data set and an objective data set or something else, and you want to compare those. And if they line up, you get a higher confidence level. And your model may take as an input what is your confidence level in that particular set or range of data. And so you can use corroboration to help you give you a confidence level. It can also be very useful in cleaning. You can say, okay, this data, I've got completely different data sets. They line up. This data is clean because I got data sets lining up. Ooh, they diverged over here. This is a suspect area. Why did they diverge? Is there bad data here, or is there a reason they diverged? So that can just raise a flag and be worth some further study. In terms of speed, clients obviously try to get data in and decide whether it's going to be useful as quickly as possible. One of the reasons we exist is that most clients are backed up and they've got 100 data sets on their queue to try to get to, and they're totally overwhelmed, and to try to onboard. And they usually take months to onboard and even look at a new data set, which is frustrating for them, is frustrating for the data vendor. Oh, another evaluation agreement. Oh, another evaluation agreement. And we try to come in and just clear up the backlog and try to, within a couple of weeks, try to get through a data set and say, okay, is it going to work? Is it not? And help people, move on quickly and put it in production or decide that's not helpful.
Final question?
Looking for bot-driven data?
Sorry?
For data that is being generated by bots of one sort or another.
Yeah.
When you're looking at consumer stock opinions,
Yeah.
there's a lot of humor.
Oh yeah, we live in the era of fake news, and we have not done anything like that to date. Again, we've been in business since earlier this year. I wouldn't be surprised if we come across those things, particularly in the subjective data spaces, sentiment spaces. There's a lot of stuff going on, spoofing.
The real data financials do not look that good, but the public sentiment looks very good. So the people might have some sentiment, and that those are signal to the markets.
Yeah, absolutely. No, people could be incentivized to do bad things.
I think we're really out of time now.
Okay.
Let's thank this.
All right. Thanks very much. Appreciate you coming.